Warm greetings to everyone. Today we'll see about futures contract. Futures is nothing but the financial derivatives that obligate parties to buy or sell an asset at a predetermined future date and price. Characteristics of futures market or features of futures market. It is a standardized contract, sizes and maturity dates, and it is dealt with in the market with the help of clearing houses, and the future contracts require you to put up deposits and satisfy margin calls if required, and contracts usually closed out on or before the maturity date rather than the physically delivered date. Then the main features of future market are: it is a standardized contract and it allows the investors and traders to exchange commodities or financial securities on trading venues or clearing houses, and it protects the investors and traders from losing money on transaction regardless of future market price fluctuations. How does a future market work? We will see with an example. It is a contract between the buyer and the seller, which is to be done or delivered at a future date. But in between, there is a clearing house to settle the contract between the buyer and the seller. For the buyer, it earns profit if the current market price rises and incurs losses if the current market price declines. For the seller, it earns profit if the current market price declines and incurs losses if we want the current market prices rises. Functions of futures. The future markets functions are: price discovery. Before making into the contract, while entering into the contract itself, the price is discovered between the buyer and the seller, mutually agreed. Then risk shifting. Allows the separation of risk of price change from the risk arising from other normal business functions, and similar to the separation of theft or fire risk from the other business risks. And the other function is hedging function. Because of the ease in transferring unwanted risks in the future market, there is tremendously flexibility in the time of purchases and sales, yet maintaining anonymity. Then it also ensures market efficiency, and as the accessibility is maximized through a single marketplace concept. Then the information benefits. In future markets, both the buyers and sellers are informed about the market situations. So these are the functions of future market. Then we'll see about the future market purposes. The main two future market purposes are price discovery or speculation, and price risk transfer or hedging. Price discovery or speculation is nothing but the buyers and sellers from all around the world coverage on a single marketplace to set commodity and financial instrument prices for future delivery and profit from market volatility. The second purpose is price risk transfer or hedging. Buyers and sellers fix commodity and financial instrument prices for future delivery to avoid losses due to market volatility. Steps in futures market trading. The main steps in futures market trading in stock market are: they have to register with the clearing house by opening a trading account. Then make a deposit for margin settling. Then buyers or sellings of as future markets contracts at the current market price. Then they enter into a contract with the future market price. Then purchasing in future indicates that the buyer is taking a long position, whereas the seller is taking a short position. Buying or selling the commodity before it expires, or buying or selling before the contract expiration date to complete the transaction is also possible in futures market. Then investors physically trade before the market is closed, before the delivery date itself, such that they get the profits. Well, who trades in future contracts? Types of investors who use future contracts are hedgers. These investors do not trade future contracts to make a profit, whereas hedgers primarily seek to shield themselves or their company from the adverse price movements of the underlying company. They act as the insurers between the buyer and the seller. Let us take an example of a corn farmer and a corn canner to understand what the hedger is. The farmer would not want the prices to go down, while the canner would not want the prices to rise. Thus, to get protection against a drop in prices, the farmer will buy the futures contracts to sell corn at a specific price in future. Similarly, the canner will buy the right to buy corn at future date at a specific price. Thus, since both have bought a contract irrespective of price movements of the commodity, they certainly of receiving or paying the contracted sum only. So, both of them are insured, have insured their risks in this contract. So, this is what the duty of the hedgers in the stock market. Speculators. They are the investors who do not intend on taking delivery of the underlying asset at the expiry date. Instead, they aim at the profit from the price movement of the underlying asset before the expiry. Now, for instance, if a speculator believes that the price of corn will go up, he would buy a futures contract to lock the current price. If the prices go up, the speculator will make a profit by selling the futures contracts, who will now be of more value. The speculator would have to sell the contract before the expiry to avoid taking the delivery. Usually, speculators face allegations of massive price swings in the future markets, but their biggest benefit is that they ensure liquidity to the futures market. Advantages and disadvantages of future market. The main advantage of future markets are more volatility, and they can make big investments even with a small amount of money. So if they settle the margin amount for their trade, it is enough. Then they relate to weather and commodities market, and then it is the contracts are based on insiders information, and trading charges are less in future markets, and these are future markets are good instrument for businesses to lower their risks. So these are the advantages of future market. Now we'll come across the disadvantages of future market. The main disadvantage of future markets are investors can incur huge losses if the margin, including their margin money, if there is high volatility. Then the big sum of money owing to minimum contract size will be a loss for the investors. And a future market is comparatively harder to understand than the stock market. So now we have seen about the disadvantages and advantages of stock market. With this, we'll end with this future contract.